I want to talk to you guys today about one of the paradoxes that is happening within the equity markets and how this translates into your retirement. So, if you're looking at having a good retirement one day, navigating all the complexities of the markets today, this video is for you. So, as we're seeing today, there's so many people, so many legendary investors are coming out of the woodworks here and sharing their opinion about what's going on in the market. So, right now, there's a lot of just cross deals happening right now in the AI space, and that's really propping up the market. Where just yesterday, OpenAI and AMD announced a partnership. We've had Oracle's huge cloud deal with OpenAI. There's a lot of moving parts right now in this space, and so just yesterday, I'm recording this on October 7th. We had Paul Tudor Jones came out and said that this market environment reminds him of the late 1999. So this was 5 years before the dot-com crash. Ray Dalio came out today and said that this market environment reminds him of the 1970s, and he was saying that investors should own gold. So right now, there is technology, and the liquidity from the technology is what's really driving the markets higher right now. So this is all happening while the broader economy is slower. So in the dizzying amount of deals that are being announced right now in the public equity markets, there's companies like Walmart and their CEO who are coming and talking out loud about what's going to happen in their businesses. And what they're basically saying here is AI is going to transform everything about business, and it is going to be it is going to take away jobs. And so, as coming from a wealth manager myself, there's just a paradox to understand here. And that paradox is that the same technology that is creating tremendous investment gains in everyone's retirement accounts and brokerage accounts is also going to be reshaping the very workforce that we use to earn money and to drive investment. To give you context here, so Microsoft, Amazon, Meta, and Google alone will be spending $400 billion this year on AI infrastructure. This is just a huge sum of money. Like I just said a second ago, that is driving markets higher, but it's also having just a huge trickle down effect in business. And McMillan, though, when he was talking and giving a keynote, again, McMillan being this Walmart CEO, he just made it very clear. This is what he said, word for word. It's very clear that AI is going to change literally every job. But maybe there's a job in the world that AI won't change, but I haven't thought of it. So as an investor, right, as somebody planning their retirement, as somebody who wants to, on one hand, enjoy gains, but also wants to also enjoy the fruits of financial stability, how should you think about this paradox, right? How should you invest more in the AI theme, or should you cut back? What risks do markets like this mean for you? And to answer that question, I want to look backwards in time, actually, to look at just other types of not market events, but really technological innovations that really have shaped the world that we live in today. So John D. Rockefeller, Andrew Carnegie, Cornelius Vanderbilt, JP Morgan, Henry D. Ford. These are names you've probably heard about, maybe haven't spent a lot of time thinking about them, but these are just legendary entrepreneurs of the, that were born in the 1800s and really created the world that we ultimately live in. And these entrepreneurs, they took really just massive risks, and they pretty much looked out west and said, I want to take advantage of this unique set of opportunities here and build some fantastic businesses and really create markets that ultimately drove like absolutely insane economic progress over the last 200 years. So just to give you guys some context of like what entrepreneurs and what just the combination of or I want to share with you guys just like the sheer amount of economic growth that happened from the backs on the backs of the Industrial Revolution. So between 1800 and 1900, our economy grew by 43.6 times, which is crazy. The real like we started bearing fruit of the Industrial Revolution in the 1900s, and then of course the entrepreneurs that I just mentioned, they really built their businesses in the early 1900s. So from 1900 to 2000, our economy grew 484 times, which is absolutely crazy. That's almost 500 times growth over just a 100-year period. And from, just to give you context, from 2000 today, our economy is about 2.3 times bigger. So to to do these, to have that kind of economic growth from 1900 to 2000 required an insane amount of investment. And we're talking about, like, I just mentioned that $400 billion is required from the top four. That's what they're spending in infrastructure. That is the type of level of investment that was needed from these entrepreneurs to build the businesses that they wanted to build. And so these entrepreneurs, they bore the risk. They created the markets, and then obviously they needed financing, which J.P. Morgan was a benefactor of that. As he formed J.P. Morgan, the banking. Goldman Sachs was in there as well. So the results of this infrastructure spend and what it did for the country that we now live in was crazy. And the fruits of that was from 1900 to 2000 is almost a 500 times return, which is crazy. Now, what's happening today is definitely similar to what was going on, particularly in the early 1900s. And today, when you think about, like, well, who are these entrepreneurs that are creating these markets and creating these types of crazy returns that ultimately flow into our economy? Think of Mark Zuckerberg at Meta, Jensen Huang of NVIDIA, Elon Musk at Tesla, Bezos at Amazon. I mean, these entrepreneurs really are investing huge sums of money that we, as holders of these companies, are enjoying tremendous returns here. But obviously, like, when you think about, like, what happened when Henry Ford built the assembly line and, like, what the societal costs were, they're obviously, it was very handy and convenient to have a car that you could just turn on and drive to wherever you wanted. But it definitely changed things, right? There's a huge swath of industry that was just put out of business because of what happened when Henry Ford started shipping tons of cars from Detroit all across America. So there's a huge upside here, with these massive infrastructure projects when when we start, we as in, just investors and just citizens of America, like, we will bear fruit from this stuff. But there's also a huge amount of disruption that will happen. So I was recently writing about in the newsletter how just life and the Fed and business, like, it all happens in cycles. And this AI boom that we're seeing, and really this AI boom that is creating liquidity, that is in the broader economy, is absolutely propping up the economy, and we're seeing it. But the executives of these companies, the investors, there's a general theme, brewing here, about what's actually happening here. And there's a recent article that I'll quote here that was talking about a $15 billion data center that is just happening a few miles north of me right now in the middle of North Dakota. To quote, this week, consultants at Bain & Co. estimated the wave of AI infrastructure spending will require $2 trillion in annual AI revenue by 2030. By comparison, that is more than the combined 2024 revenue of Amazon, Alphabet, Apple, Microsoft, Meta, and NVIDIA, and more than 5 times the size of the entire global subscription software market. So when you hear things like that, when you hear about $400 billion being spent on AI infrastructure, which is going straight into the economy, and investors are assuming that will yield some multiple of return off of the spend, that's great. But then when you think about, and when you hear, like, what type of revenue that spend needs to create, it is more than 5 times the size of the entire global subscription software market today. So these expectations of all of this to pencil out are sky high. And now, so when you would talk with, like, an executive of these companies that are investing heavily in AI, their counterpunch, of course, to those sky high expectations are, well, this will work because AI is going to cut the largest expense on any business's P&L, and that is labor. So that sounds great for investors, but from the actual families who earn money, who are working, that means layoffs. And that's where this hits home here. So there's been a recent trend in how Americans are spending their money. So Barron's ran this article last week, noting that Americans are giving less to charity. So even amidst this huge run up in the equity markets over the past 15 years, some of the best returns we've literally ever seen in market history, Americans are giving less to charity, but they're not being less generous. More Americans are supporting the generations either below them or above them with their own money. So they're giving less to charity, but Americans are giving more to their own family to support them. And this is what I ultimately think the AI boom. This is what this will mean for people. Is investors, like we as investors, will enjoy some phenomenal gains. Have enjoyed some phenomenal gains. While on the flip side, families are going to support themselves and support their kids who maybe had a layoff, or supporting, recently graduated college kids that they can't get a job at the level that they thought they would have maybe 5 years ago when they were thinking about college. And so there's going to be gains, and then there's going to be losses. And from a personal finance perspective, and as a wealth manager, these are just things that we're thinking about for our clients here. Is we want to enjoy the gains that we're seeing in the marketplace, while we also are very aware that, well, this could cost families extra in retirement, or not only retirement, but it just could mean that our clients, have less money if they get laid off in their 50s. And, what are you going to do about it if you can't replace your $200,000 job like you maybe could have in the 2010s? So when you look at the market right now, it is amazing how concentrated investors are in the AI theme right now. And again, this isn't a bad thing, and this isn't like doom or gloom necessarily. I'm just talking about, if this doesn't work out, what is this going to mean for, on the personal finances, on your personal finances. So right now, the top 8 companies in the S&P 500 control about 37% of the market share, which is a historically high number. So when you think about the composition of the market, when you think about your portfolio, there's going to be a big swath of it is going to be directly related to AI. And I just told you guys that the expectations for this to work out are just sky high. And I think we ultimately know what, when markets go up really fast, they tend to go down really fast as well. And things average out over time. But I think when we're looking at the past, when we're looking at the companies that created this transformational technology, it was good, but it also was bad. And I think that's how to view this in your financial life. And I just want you to picture this too. So let's just say you're 55, and your 33-year-old son with a wife and 3 kids gets a call at 9 a.m. And it's from his boss, and his boss tells him that, hey, I really hate to have this phone conversation, but your employment effective immediately is over. We just had our CEO announce layoffs, and you were unfortunately part of the cut. We're really sorry. We're going to give you 3 months of severance to hopefully make this work out for you, but we're sorry. So the phone call ends, just a few-minute phone call, really sad. Your son immediately goes into his finances and figures out, okay, like what does this mean for me? I've got 3 months severance. I got to really brush on my resume and figure out if I can get a job. So then he calls you, and he's wondering if you can potentially help them bridge the gap if he can't, for whatever reason, find a job that was paid something similar to the job that he just lost. And furthermore, he says that their youngest son had some health problems, so they had an unexpected health bill they weren't thinking, and they just had to buy a new vehicle because their family, they're 33 and they have 3 kids now, and they just need more space to just tow the family around town, right? And so they've had to spend quite a bit of cash on these unexpected expenses. And so you, on the flip side, you're like, yeah, I've made a lot of money. But you weren't exactly expecting this conversation. Maybe you were, but you weren't maybe expecting this so soon. And you have a few other kids, and what if they do the same thing, right? And so I think this is just the paradox: is there's a huge gain to be had with AI, and there's also just the human cost. And I think the human cost right now is what no one knows about, and that's exactly what the CEO of Walmart is saying: is we just simply don't know what this will exactly what the costs will be. And so I think the takeaway here for you is that there's a lot of people saying AI is in a bubble right now. The Bain and Company, they were saying that the market has to grow an extraordinary amount over the next 5 years to meet the expectations of what investors are placing on these companies who are spending tens of billions of dollars building out infrastructure. So this will no doubt change the world. Already has. The expectations are high, and it sure looks like we might be in a bubble here. And so no one knows the end game from an investment perspective. And surely no one understands exactly where this will be and what the societal costs are. But what I am sensing and what I am just, thinking about is that if you are in your 50s, if you are planning for retirement, I think that the trend of how Americans are spending money, which is supporting their families more, I think that will only continue and maybe even continue to a greater degree in the next 10 years. So really the takeaway here is this is simply like you've got to understand your portfolio. First of all, like what is your exposure to AI? People who have a lot of exposure have made a lot of money, but there's also portfolios that are heavily weighted to AI right now. It's really difficult because the probability of outcomes, the range of outcomes that your portfolio could experience is it's really big. So that means it's difficult mathematically to plan for retirements. So there's a portfolio side. Then the human cost side is, for me, what I personally think about is I have a 6-year-old daughter, and I have a 529 plan for her, and I just don't know what the future holds. I know college will probably be $100,000 a year for her, just on average. Know that I want her to have financial flexibility. I am willing to support her, but I also don't exactly know where things are going to land for her from a job perspective, right? That's 15 years in the future, but ultimately, like, we don't know what the human cost of this will be. When we look backwards in time and look at just these huge transformations of technology, they were good. Like they have ultimately set us up for today, for humans living in 2020 in 2025 to do these things, to create the blockchain, to create the cloud that then created AI. It's incredible the fact that just in our pockets we have the equivalent of Albert Einstein in any single field known to humans. That is incredible, and that will be good. That is good, and it will be good. But of course, there's going to be some fallouts, and what you don't know is what exactly side of history you will fall on. And that's where just simply having a conversation with your financial advisor, just having a sober conversation with your spouse of like, what does this actually mean for us? What if our portfolio went down 30%? What if all 3 of our kids got laid off because AI took their jobs? What does that mean for us and our family? So, and I obviously can't answer that question, but that is a question to be keeping on your mind. So that's all for this week. We'll see you guys next time.